And that suggests that the market could easily go down by 50% and be well within its historical boundary. That would not be a colossal low.
These words belong to Jeremy Grantham, one of the greatest living investment legends. Grantham, known for accurately predicting financial crises years in advance and dubbed the Cassandra of the investment world by The Economist, believes that today's markets are going through one of the most dangerous periods in history. Today, we will examine his views in detail and learn incredible things. According to him, what we are seeing now is not a simple market fluctuation. It's the final stages of one of the greatest super bubbles in history. So why is Grantham so pessimistic? And more importantly, how can we, as ordinary investors, survive these treacherous waters? In this video, let's take Grantham's warnings as a starting point and address the topic from a much broader perspective. Let's look at the anatomy of market bubbles, the forgotten lessons of the 4 biggest crashes in history, and how the artificial intelligence frenzy is making this bubble even more dangerous. But first, let's hear from Grantham himself, why he compares the current market to a fog of war, and why the old rules no longer apply. I ask that you watch the video carefully until the end.
And that's a pretty good analogy with the market from my perspective. It's seldom easy to see what's coming. You only get a little kind of glimpse through what they used to call the fog of war. And now you don't even get that glimpse. All the old ratios don't seem to work for a variety of reasons, but you start with COVID. COVID rattled the world to its bones, and then the COVID stimulus was an order of magnitude bigger than anything we had ever seen. And it ended up with trillions of dollars in very weird hands. People who were bored and forced to be at home with nothing to do but speculate on stocks, and they did. And it stayed that way. So even in the recent decline, the selling was by institutions, the buying was by individuals. This is incredibly new. So that's influence number one. The second great difference here that's also changed all the traditional responses is the introduction of AI, which really came to be recognized with ChatGPT in October 22. And we were having what you might call a traditional bear market. And it kind of ended overnight with half a dozen Mag 7, half a dozen, roaring upwards and eventually dragging the market with it. That cut right across all the traditional reflexes. And then finally, we have a tariff war. So if anyone can unravel that series of abnormal influences, we're still unpredictable because of COVID response. We're certainly still unpredictable because of AI. No one knows what AI is going to do. It's going to change the world, but no one knows when and how. And on top of all that, no one has a clue what the tariff war is going to do and how quickly it will do it.
To understand this complex and foggy environment Grantham describes, we must first clarify the basic concepts. If we don't understand these fundamental concepts, we cannot understand the topic. In the world of investing, there are 2 fundamental philosophies. The first is buying what is cheap, the value investing philosophy, and the second is buying what is expected to grow rapidly, the growth investing philosophy. In fact, whether you realize it or not, you are applying one of these 2 philosophies when you buy things. Value investors buy companies they believe the market is pricing below their true worth. This is a school of thought associated with names like Warren Buffett. Growth investors, on the other hand, focus on companies in innovative sectors like technology, which may seem expensive relative to their current earnings due to their future potential. This distinction is critical for us because market bubbles are almost entirely a product of growth investing. Narratives about the future overshadow today's value analysis. A value investor like Grantham is, by nature, a bubble skeptic. A market bubble is a rapid asset price inflation driven by exuberant market behavior where prices detach from their fundamental values. There are 2 main tools used to measure this inflation, and if we consider these 2 tools when buying something, we can understand whether we are buying at a fair value. The first is the price to earnings, which shows a company's price relative to its earnings. You have likely heard of this as the PE ratio. Historically, for the S&P 500, this ratio is around 14. It's simply found by dividing the company's price by its earnings. In this chart, you can clearly see this ratio changing over the years. What I'm explaining might seem basic, but I need to explain it for those who are new to this, so that everyone can grasp the main idea by the end of the video. The second is the market cap to GDP ratio, which Warren Buffett has described as probably the best single measure of where valuations stand at any given moment. This ratio is a reality check, showing how inflated the entire stock market is compared to the real economy that supports it. For a bubble to form, financial conditions alone are not enough. Strong human psychology is also required. I've mentioned this in my previous videos. A state of enthusiasm, which Nobel laureate economist Robert Shiller calls irrational exuberance, is created by rising prices and spreads from person to person. This, combined with the fear of missing out, FOMO, leads to herd behavior, where people set aside their own judgment and follow the crowd. The father of value investing, Benjamin Graham, explained the situation with his Mr. Market allegory. Mr. Market is a manic depressive business partner who offers you different prices every day. The investor's job is to ignore his moods and take advantage of his euphoria, high prices, or his despair, low prices. I believe this is the most important explanation for us to understand the market's direction.
The quote attributed to Keynes, although he unfortunately never said it, he should have said it, is that the market can stay irrational longer than the investor can stay solvent.
Yes.
And that's really true. If you're in the institutional business, as we have been, you run the risk of getting forced out of your positions, even if you're right. And in 2000, we were right. The PE went to a new all-time high in January 98. It overtook the previous high of 1929 at the top of the legendary bull market. And then it just kept going. 21 times earnings, 23, 27, 29, 31. Oh my God, it has to stop. 33, 35. And at 35 times earnings in March of 2000, it finally quit. And how were you to know once you were in new high territory like that? And earnings continued to rise. So you not only went from 21 to 35, which is kind of a 50% hit, but you had earnings go up 20 as well. And of course, there's no way of knowing. And all you know is that in the end, it doesn't change the outcome. It just meant that the break from 35 times earnings was spectacular. And the NASDAQ that led the charge upwards went down pretty much 80%. And the same in Japan, although Japan is even worse. Japan had never sold over 25 times earnings, and then it did. And for some miraculous reason, we stayed invested until about 45 times, and then we got out. We said, this is ridiculous, we're out of it, 100% out. It was the biggest part of foreign portfolios, the EFA index, and we went to zero. And then we watched as it went from 45 to 50 to 55, to, you must be kidding me, to 60 to 65 times earnings, by which time we had underperformed by 10 points a year. It came back all the way, only instead of taking 5 years, it took 20 years. And now Japan finally is an ordinary country selling a little bit cheaply from the highest price of any major market ever by a lot. So you have a wonderful ride on the way up. It changes nothing. Eventually they come down. But getting the timing right, just about impossible. And in each case of the great ones we got right, we suffered a lot.
Yes.
Japan and 2000. And the one we got fairly right was the so-called great financial crash, because we focused on the housing market. And we saw how much overpriced it was. So we knew it was coming down. Housing market was unbelievably well behaved. It went up to, in statistical terms, a 3 sigma event, which is the kind that would occur every 100 years or so. And then it came all the way back down again. It was beautifully symmetrical. It took 3 years going up, 3 years coming down, sucked in a lot of poor people into the housing market who should never have been there, gave an opportunity for the rent seekers, as we call them, to design crazy bits of sliced and diced subprime mortgage paper to sell to idiot European banks and so on. And then the shock nearly destroyed the banking system.
Yeah. Grantham's personal experiences reveal the repeating, painful lessons of history. People essentially keep doing the same things without learning from their actions. Now let's take a closer look at these 4 major historical bubbles to understand our current situation. By doing so, we can see how much our situation resembles the past. Our first bubble, the 1929 crash. In an era of prosperity fueled by new technologies like the automobile and radio, buying on margin, speculating on stocks with borrowed money became widespread. When the bubble burst, the Dow Jones Index lost 89% of its value from its 1929 peak to its 1932 bottom. This crash triggered the Great Depression, and it took 25 years for the stock market to return to the same level. A full 25 years? Can you imagine how huge that loss is? But that's nothing compared to our next bubble, whose effects are still felt today. Our second bubble, Japan's bubble economy of the 1980s. Cheap credit and technological dominance led to rampant speculation in stocks and real estate. At its peak, it was said that the land under the Imperial Palace in Tokyo was worth more than all the real estate in California. People were officially blind, believing each other's lies. The Nikkei index reached an unbelievable PE ratio of 65 times earnings. After the crash, Japan entered a long period of stagnation known as the lost decades. Japan has still not reached its desired growth rates to this day. Look at the damage such a massive bubble caused to an entire country. And our third bubble, the dot-com craze of 2000. A revolutionary technology, the internet, fueled the new economy narrative. I'm sure most of you watching this video remember it. Stocks of companies with no profits or even a business model skyrocketed. After rising fivefold in 5 years, the Nasdaq index fell by more than 77% between 2000 and 2002. Imagine waking up one morning to find you've lost 4/5 of your money. It would be the last thing I'd want to experience. The best example of this era was Pets.com, which went bankrupt just 268 days after its IPO. People were buying like crazy. They were just investing in hope. They hyped each other up and drove the price higher and higher. Then what happened? A total disappointment. Another lesson is that even a revolutionary company like Amazon, if bought at its 1999 peak, made its investors wait a decade to turn a profit. This is proof that a great company may not be a great investment if bought at a bubble price. See what can happen when you buy even one of the world's largest companies at the wrong price. I'm telling you this because we can't invest just by looking at what others are doing. We have to be realistic, my friends. Now, let's continue. Our final bubble, the 2008 global financial crisis. A housing bubble, fueled by low interest rates and lax lending standards, went global as risky mortgages were packaged into complex securities and sold worldwide. When the bubble burst, credit markets froze, and the world was plunged into the worst economic crisis since the Great Depression. I'm sure no one remembers this better than we do. For America, life officially came to a standstill. We still see the effects today. Nothing gets fixed overnight. While no one expected such a thing, Grantham was continuing to issue warnings even then. My intention is not to praise Grantham or anything. I don't blindly defend any expert, but I can't completely close my ears to such warnings. Now we are seeing these warnings for artificial intelligence, and you will soon understand better why a new bubble is forming. Let's keep watching.
I think the speculation in after COVID stimulus was more impressive than anything we have seen.
Right.
All that speculative money from the COVID stimulus, where they were hopping around saying, AMC, let's take it to the moon, and the thing was going up 40 times in 2 weeks, and becoming billions of dollars, and forcing the poor hedge fund guys into jumping out of the window. There's no way you can calculate things like that. It was on such a scale, and there were so many of them, each one more ridiculous than the next. No, I think that was a good candidate for beating 1929.
And has that been corrected sufficiently?
Well, that was the interesting thing. Quite a few of those things just fizzled away to next to nothing. The market itself never corrected. It was beginning to in 22, of course. That was a major 25% wipeout. And in that, the growth stocks came down 50% in a hurry. But then they rallied so much with,
Well,
with
yes.
AI that they got it all back in the following year, stabilized the whole market again, which went to new highs. So there's no precedent for this kind of bubble within a bubble. We had all the frenzy, all the speculation. We had the thing bust. We had a lot of the flakes go to nothing. We had the growth stocks come down 50%. And then they rewrite the novel with with AI. And AI, of course, is the real McCoy in the sense it's a major, major development. And people say, well, then it's not a bubble. And I say, it's quite the reverse. The great inventions, like railroads, and I'm told the canals even before them, internet, the more you could see that they were brilliant ideas, the easier it was to see how they would change the world, the more effective it was of sucking in your money. Of course, why would it not be? So they designed 6 railroads between Manchester and Leeds, which is not a great idea. It changed the world. It brought down the cost of transportation. Everyone's GDP was helped, but the people who invested in the railroads had a terrible bust. And out of the wreckage, the world advanced. Internet was identical. Amazon and the boys, the little flakes like pet.com, they all went to nothing in 9 months or so. But Amazon, believe it or not, went down 92% in 2000 and 2001. To the low of that market move, it fell 92%. And out of the wreckage, the internet was a terrific, life-changing idea. And it worked. And it's precisely those wonderful ideas that actually work, that suck in the money and give you upfront the biggest bubbles. And you would have to think that AI is right up there in the general significance potential. It's hard to imagine that will not be a bubble. And out of which wreckage, I really count on the fact that AI will change everything. Some for the good, some for the bad. It's going to be the biggest destroyer of jobs that you have even thought about.
This is the thesis Grantham calls the great invention paradox. The more revolutionary and transformative a technology appears, the easier it is for investors to rationalize any price and abandon valuation discipline. Currently, bull market defenders say, this time is different because AI will create an unprecedented productivity boom. For example, Cathie Wood's ARK Invest predicts that AI will create a $13 trillion opportunity by 2030. Bear market defenders, along with names like Warren Buffett and John Hussman, say the internet was also very powerful and that belief justified a PE ratio that resulted in an 80% crash. The debate is not about the ultimate impact of the technology, but about the market's ability to price that impact rationally in the short term. In other words, people are instantly influenced by what they hear and start driving up prices. Look, just last year, they threw out something called the metaverse, and people bought in at crazy prices. What's their situation now? We need to look at things differently, my friends. One reason these bubbles last so long is the career risk faced by professionals. As Grantham says, you don't get fired for losing your client's money in a bear market, everyone does. You get fired for being wrong on your own. A fund manager who avoids a rising bubble underperforms their peers and loses clients. Therefore, joining the herd becomes a rational career decision, even if they know it's irrational. Thus, the very system that is supposed to manage risk ironically becomes a mechanism that generates it. The situation with these funds we trust so much is no different right now.
What should you do now? The stock market is gloriously overpriced in the US, but foreign stocks are perfectly reasonable. And when you have a major bubble, you also have incredible stretching of traditional relationships. So the gap between value and growth is as big as it gets. It's in the top few percentile of history. And the gap between foreign and the US is at or close to an all-time record. So these are the things you have to do. Emphasize value, emphasize non-US. And if you're in the US, and you have to be, and I have to be a little sympathetic, most people really have to be in the US, the thing to do is concentrate on risk. One way to do that is high quality. High quality has less debt. If the economy goes into the tank, and it may well do just that because of the tariff war and other problems, record debt and so on, you do not want to have debt. And high quality companies have very little. And you want to have high profit margins so they can be squeezed without sending you out of business. Climate and resources have been utterly crushed, even if they are American securities. A lot of them are not. And resources not only are unprecedentedly cheap, but they are the only group that tends to be uncorrelated to the broad market. As in, on a 10-year basis, they have no positive correlation at all. That is the only group. Do what you should do when you invest, kind of lock them up for 10 years and throw the key away. You will make a decent amount of money. But if you do that in the S&P, I think 50-50, you won't make any money at all.
In summary, Grantham's warning and the historical data we've added present a clear picture. The current market exhibits all the characteristics of the biggest speculative bubbles in history. According to Grantham, it's highly plausible that the S&P 500 will deliver 0 real returns over the next decade, and a 50% drop from the peak would be within historical norms. And his most thought-provoking warning is the fact that the technology fueling this financial bubble, artificial intelligence, could also fuel future social instability. Finally, let us leave you with these provocative questions. Is it better to be wrong with the crowd or to be right alone and risk losing your clients? And if it's guaranteed that AI will change the world, does that make it a good investment at any price? I await your answers in the comments, and I reply to all of them. But wait, it's not over yet. What if I told you that a perfect plan to solve our country's debt problem was prepared over a decade ago, but was shelved due to political ambitions? In our next video, we tell the dramatic story of this plan called Bowles-Simpson and the 2 famous political promises that destroyed it. Click the screen to learn the behind-the-scenes story of this missed historic opportunity. Thanks for watching.